Last time, we talked about what broke in 1907. Today, we start building the cure. Paul Warburg didn't just criticize, he drew blueprints, including essays such as a plan for a modified central bank through a central bank system in the United States of America, a United Reserve Bank of the United States, and onto the discount system in Europe and circulating credits and bank acceptances. Together, these essays show a reserve-centered system with a working discount market, which is the intellectual scaffolding that later became the Federal Reserve. And by 1910, he was explicit for his new plan by publishing an essay titled The United Reserve Bank of the United States, built around cooperative reserves, not just more currency. Warburg's cure had two moves. First, combine scattered reserves in a national institution so the system can meet stress as one balance sheet, not 1,000 isolated ones. Second, normalize rediscounting, a real market and short-term two-name paper, acceptances and bills, where a central institution can buy and sell to steady credit. Seligman's introduction to these essays spells it out. Warburg shifted the debate from currency to reserves, and from ad hoc lending to a discount policy worthy of the name. In modern terms, the discount rate is the steering wheel, but it only steers if there's a robust bill market and room for the central bank to take initiative through open market bill purchases. Start with the institutional sketch. In a plan for a modified central bank, Warburg proposes a Washington bank with public-private capital and a directorate designed to be independent of partisan politics while anchored in real commercial experience. It would hold Treasury funds, set a general rate on deposits, and crucially, work through clearinghouse institutions and high-grade collateral rather than scattershot lending. He's not just tinkering, he's centralizing the reserve function, because without combining reserves, you can't protect the whole market when stress hits. Then come the instruments. Warburg wants two-name paper bankers and trade acceptances to replace the stock exchange call loan as the nation's secondary reserve. But why? Because a bill market lets policy work smoothly through price, the discount rate, rather than jerky shifts in call money. Later essays show the logic in action. Acceptances should be the prime asset in bank secondary reserves, but their ascent was long obstructed by Treasury certificates and the habit of parking funds in call loans. Build the acceptance market, and the central bank gains a field where it can enter or withdraw at will, shaping conditions via open market bill purchases instead of waiting passively for banks to borrow. You can also hear Warburg thinking nationally, not parochially. Domestic acceptances, he argues, would equalize money rates across seasons and regions, cotton harvest paper in the South flowing to money centers through dealers, discount companies, or the reserve banks, spreading liquidity where it's needed, when it's needed. That's the practical face of cooperative reserves. A market mechanism that moves cash to sound collateral without panic or favoritism. Finally, Warburg's own retrospective ties the arc together. From his United Reserve Bank in 1910 to Aldrich's National Reserve Association to the enacted Federal Reserve System, the common denominator was cooperative reserves, the structural change his blueprints were designed to achieve. If episode 2 was What's Broken, today is How to Fix It. Combine reserves and build a discount market so the rate becomes the policy lever and acceptances replace call loans as the safety valve. Next time, we'll unpack these tools, discounting and acceptances at street level. If you want the full picture, grab Paul M. Warburg's The Federal Reserve System, Its Origin and Growth. Owning the book lets you follow the blueprint essay by essay and see how the ideas are evolved into law.